the market taught me in 2018 was this uncertainty and volatility really is here to stay. It really is the new normal, so we just need to get on with it. What I'd like to do today is provide some insight on how we invest with conviction, particularly during these times of heightened uncertainty. But all this uncertainty will create opportunities. The first part of the presentation, I'll touch on the volatile end to 2018 and what are some of the headwinds we're experiencing now in 2019 and why all this uncertainty will create some great buying opportunities, we believe. The second point is that we all know 2018 was a tough year for investors, and it was for Firetrail as well. But we haven't changed our approach. So I'll spend a few minutes to talk about our approach for stock selection, which is all about every company having a price. And then finally, I'll talk about our two very best stock picks for 2019. But looking back over the last 30 years, you can see that the Aussie equity market has had a lot of events, a lot of issues, and a lot of risks. But there's two observations I'd like to bring forward here. The first one is for long-term and patient investors, the Aussie equity market has been an outstanding investment. In fact, if you invested $100,000 in 1992, that investment today would be worth well over $1 million. The second observation is history has shown that there's numerous amounts of issues and risks over that period of time. And when you're experiencing this uncertainty live, it does really feel like it's the beginning of the end of the equity market. How can the equity market recover from these unfortunate events? Many of you would have remembered investing through the GFC or the Euro debt crisis, or last year, that fourth quarter of 2018. Incredibly stressful during these times of uncertainty. But the key point with this slide and with all that uncertainty is the market is incredibly resilient, so you need to stay the course. The market turns quickly and recovers incredibly quickly, as you can see from this chart. Volatility really is the normal part of investing these days. But let's talk about what happened in 2018. Firstly, a reality check. The full calendar year to 2018, the equities market was only down 3%. This year already, the market is up over 6%. But it's fair to say that fourth quarter was a difficult one. The market was down over 9%. We saw a big rush out of cyclicals into defensives, particularly in that last quarter where defensives outperformed by 8%. Large outperformed smalls. Again, a chase for large cap in that fourth quarter. The market was chasing those BLDs, those big liquid defensives. And then we saw growth companies as a group over the full year at around 8%. But again, a massive reversal in that fourth quarter where value outperformed quite strongly. So what caused all that uncertainty over that last quarter of last year? Well, it really was a confluence of a number of events, and they all related to two things: the risk of falling global growth and at the same time, the risk of heightened inflation. Now, generally the market is very resilient. It can cope with one of those issues at a time. But the market in 2018 was incredibly rattled when it was faced with a combination of both falling growth as well as rising inflation. Now, if we fast forward to where we are in 2019, we have exactly the same headwinds today as we had last year. We'll talk briefly through some of those, but the key point about all this uncertainty is all this uncertainty is here to stay, but it will create a lot of buying opportunities. But let's go through a couple of these now. The first one is obviously the trade war. Now, the trade war started up in around March of 2018, where Trump announced 3 rounds of tariffs against China for $500 billion US, totaling up to 25% in tariffs. Incredibly inflationary, as well as very, very negative for global growth. But it does appear in the last 6 to 8 weeks that both the US and China are walking in the same direction. Now, there's still a lot of risks here, and we'll get a lot more clarity in the next week or so. And we don't know what Trump is going to tweet in the next day or two, but it does appear that China is making initiatives to improve that trade deficit. The first thing, by buying more US goods, soybeans being one of them, by reducing tariffs on a lot of US-made goods, US cars in particular in very recent times. Further liberalisation of foreign investment, so US companies investing in China, particularly in the areas of education and medicine. And then finally, much stronger or much more enhanced IP protection. So eliminating that forced technology transfer that really did upset a lot of the US multinationals and obviously the US government. But the key point about the trade wars is the intention versus the reality. This all looks very good on paper and it looks like it might be resolved quickly, But what's the reality? What is China and what is the US going to do? Again, we'll get more clarity in coming weeks and months. The second one is US growth and inflation. Now, the US Fed Chairman, Jay Powell, gave global equities really a short-term get-out-of-jail-free card just 4 weeks ago. He didn't raise rates, which was expected not to raise at that period of time, but he did change his commentary to include the word patience. And that now allows the Fed to raise rates if inflation gets out of control, but most importantly to cut rates if we're at risk of faltering US economy. And obviously the US equity markets or global equity markets really enjoyed that. US equity markets were up around 8% very soon after that announcement. We've also seen the RBA Governor Philip Lowe just last week broadly say the same thing, saying that monetary policy here is fairly evenly balanced. The next rate rise could be up or it could be down. So patience was a real relief for global equity markets. But what's behind that word? Does that mean that the Fed chairman is very concerned about the slowing US economy? Again, we'll get more clarity during the year. Brexit. Now, it's really at the pointy end of Brexit right now. 31st of March is apparently D-Day. One positive ounce of news in the last 6 to 8 weeks is the UK Parliament have broadly agreed that they do not want a no deal. So although a hard Brexit is still a possibility, it's much lower possibility today than what the market was pricing in December of last year. We believe the likely options are really just kicking the can down the road, extending Article 50 and making a decision post the 31st of March on how they unwind away from the EU. What the market wants and what we at Firetrail want is the EU and the UK Parliament to agree on that Irish backstop, to move ahead with the soft Brexit so the UK economy can be unleashed and start outperforming again. We believe the market is at peak bearishness right now. China policy. Now, China's been slowing since about May of 2018 for a couple of reasons. Obviously, the trade wars. The China consumer is spending a bit less. But China in 2017, early 2018, tightened liquidity way too much, and it really did slow their economy down. The beauty about China, though, is they have a lot of levers and they're happy to use them very aggressively. So again, in the past 10 weeks or so, they've started to restore business confidence by cutting corporate tax rates for SMEs by 1% to around 16%. They're attempting to stimulate the consumer, again by tax cuts, but in particular in the form of rebates for childcare, for rental assistance, and also mortgage payments. And they've really addressed that right at the middle income earners of China, 130 million of them, that they really are the engine of the Chinese consumer. They got their first payment in October, and they got their second one in January of this year. And then finally, improving liquidity and lending. A lot of small levers here, but one in particular in very recent times, they've increased the bond issuances with local government to stimulate infrastructure. So surely a mild positive for the Aussie resource market. But again, that tightening last year, are these initiatives too little, too late? And again, we'll get more clarity over the next 2 to 3 months. And then finally, on the usual domestic challenges, residential property has struggled for a couple of years. But how much has it actually affected the consumer? Well, if you looked at the retail sales figures last week, they were absolutely awful. So it is actually affecting the consumer directly. Household asset bases are falling, household debt is still rising. So it really is a bad mix for a strong economy. We've got the federal election coming up. Who knows who's going to win at this stage, but what we do know is that we're at the crossroads at policy differences, whether it's tax policy, investment tax, personal tax or corporate tax. We've also got differences in immigration and energy policy. We don't know who will win the election, but what we do know about the federal election is that it'll increase the volatility up until the end of May, but also without a doubt, there'll be an enormous amount of opportunities post the federal election, and it really doesn't matter which side wins. And then finally, we've had the Royal Commission. One of the best examples I've seen in recent times, a lot of tough talk, but soft recommendations. But there still are a lot of headwinds for the banking sector and diversified financials. Much higher political scrutiny, much tougher credit controls, much higher compliance costs, now a regulator with a lot more teeth that will act, and finally, a lot of unhappy customers. So I think the banks and financial institutions generally will find it tough in this economy going forward. But bringing all these macro headwinds together, The key point at Firetrail is we want to know as much as we can about these macro headwinds, but we don't try to predict the resolution or which one will affect the market the most. What we try to do is reduce our exposure and insulate the portfolio as much as we possibly can and just let our stock selection do the talking. Uncertainty will create opportunities for 2019. And these opportunities will be found in all corners of the market. At Firetrail, we believe that the market constantly undervalues both growth and value stocks. And that allows or gives us the freedom now to actually look in all parts of the market to add value for our client base. And effectively what we look out for is when the market derates either a growth company or a value company away from its historical average because of an issue that has come up. And that's when we do clearly the deep dive fundamental research. Now the skill at this point is to uncover whether this derating is temporary and will recover or whether it's permanent. Temporary being, cyclical in nature, a one-off negative event, and eventually the company will re-rate back to its historical PE range. Or was the market right and it was structural and that derating of the PE should be permanent and that company should trade at a significant discount going forward. Now history is littered with examples of where the market constantly undervalues or overreacts to news and undervalues both growth and value companies. Two, we think the market derated last year for the wrong reasons, cyclical issues which they will re-rate back in time, are our two best ideas for 2019, Wally Parsons and Nufarm. And I'll spend a couple of minutes on each of those. Now, Wally is a global engineering firm. Effectively, they specialise in hydrocarbons, chemicals, and the mining sectors. Their key specialty is the oil and gas sector. So why buy Wally? Three things that matter for Wally. Currently, the global oil and gas capex cycle has turned, and it's turned quite strongly positive. Wally will be a major beneficiary of that. Secondly, management have embarked on significant cost-out opportunities, and there's a lot of dividends coming as a result of that. The company has been totally transformed in the last 2 to 3 years. And then finally, in October last year, they acquired a US business called Jacobs ECR, an outstanding EPS accretive business for Wally. Now, I'll touch on all three of those in a moment, but really, why was Wally derated last year? Why did the opportunity present itself to the Firetrail team? Well, firstly, it was because of the Jacobs acquisition. It was a $4.5 billion acquisition, and they issued $3 billion more scrip to the market, effectively doubling the size of the available scrip on the market. So the market effectively had a $3 billion stomachache, which it really needed to digest and find the right holders long term for that company, and that took 2 or 3 months. The second one was the fall in the oil price. The market incorrectly assumed that the fall in the oil price would negatively impact the engineering projects that Wally was going to receive. In fact, they've actually won more engineering projects since June 2018, when the oil price was falling, than they did at their peak in 2014. So Wally is a material opportunity, but why? What is the main reason? What really matters for Wally? Well, firstly, it's that oil and gas capex cycle. It has turned. What we have here on the left-hand side is Wally's revenue history over the past 10 years. And this revenue history has an incredibly high correlation to the oil and gas capex cycle. If you cast your mind to 2014, which was the peak of revenue for Wally, that was when oil was trading at $110 US a barrel. The next 2 years, oil collapsed down to $30 a barrel. As you'd expect, the oil and gas majors shelved a lot of projects, reduced their maintenance capex and also reduced their investment capex. As a result of that fall, you'd expect Wally's revenue to collapse, and it did that. It effectively fell by around 50%. But what's happened since 2017 is that oil and gas capex cycle has bottomed and it's turned quite strongly. And the reason for that is because of that underinvestment by those oil and gas majors in 2015 and 2016, there's effectively a series of capex catch-up that will really extend over to 2024 and 2025. Wally will be a direct beneficiary of that capex catch-up. The second reason you buy Wally is because of this good-looking man here. Tom is a great guy and he's a very, very experienced operator. He was the CFO of both Computershare and Transurban, and in 2016 he was offered the role of CFO for Wally to really shake it up. And he's done exactly that. He's actually taken $500 million off the cost base already. He's totally transformed the balance sheet and he's also totally improved the cash flow statements as well. Tom Honan really is a game changer for the Wally business. Now, the third reason we really like Wally is because that Jacobs ECR acquisition in October last year, it was incredibly conservatively funded. It was very complementary and a strategic acquisition, so much so that Wally's 3 business streams now, it's actually global #1 player in 2 of those business streams. It now allows them to bid for those mega Middle Eastern projects that they were broadly precluded from in the last couple of years. There's well over $130 million of synergies, and if Tom has his way, that number will probably be close to $200 million in the next 6 to 12 months. And it's incredibly EPS accretive for Wally shareholders. It really was a great acquisition. But Wally today is just way too cheap. It's trading on 13 times FY20 earnings, and for a good quality company with strong earnings that will grow for 4 or 5 years, it is just way too cheap in our view. Even excluding Jacobs, the business today, with the current oil price at around $62, is worth close to $17 a share. And if we're right with the Jacobs acquisition and we're right with Tom's initiatives with regards to synergies, this company is worth over $20 a share and really a 40% uplift of where it is today. And it's a top three position for the Firetrail High Conviction Fund and the Absolute Return Fund. Now, another one of our very best ideas for 2019 is Nufarm. Now, Nufarm are specialists in chemical crop protection. Effectively, they assist farmers in eradicating weeds, pests and disease. They're a global company and they have around a 6% market share. You buy Nufarm for 2 simple reasons. Firstly, the significant global industry consolidation that's happening right now. Nufarm will be a beneficiary of that. The second is the omega-3 opportunity. Now, I'll touch on both of those in a moment, but why did the opportunity of Nufarm come up? Why did it get derated last year? 2 reasons. Firstly was because of glyphosate concerns. Now, glyphosate is the most used and recognised weed killer around the globe. It's been in the market for over 25 years now, and there's over 800 studies that highlights its effectiveness, but also its safety. But in August 2018, a Californian civil jury determined that glyphosate could have caused a man's cancer. Now, I don't want to go through this very sensitive issue in detail today, but what we do know is that glyphosate is less than 15% of Nufarm's revenue, and it's falling. And under all reasonable circumstances, Nufarm is very well placed against this, potential glyphosate issue. The second one is obviously the Australian drought. Now, 2018 was an incredibly tough year for farmers. Rainfall last year was one of the lowest in 50 years, in fact. Less rain, less crops, less crop protection required. But what we do know is that rainfall and drought are very cyclical in nature, and generally, if not always, the very best time to buy an agricultural company is right in the middle of a drought, when there's peak bearishness and our fair weather investors will sell these companies incredibly cheaply. Rainfall and drought are cyclical. Nufarm is a fantastic opportunity, but what are the real reasons that we should be buying Nufarm? Well, firstly, it's because of this industry consolidation. The big 6 are about to become the big 4. And because of these changes, there's 3 really good opportunities that Nufarm will get a benefit out of. The first one is much better pricing, because obviously going from 6 competitors to 4, pricing will improve slightly and margins right across the board will improve. Also, these competitors are incredibly distracted right now with integration. So Nufarm will be able to expand or build on their organic market share already over the next 2 or 3 years while these majors are distracted. Then finally, there's been a lot of forced asset sales. So again, Nufarm's been able to pick up businesses to improve their product base, but also improve their global distribution network. The second reason you'd buy Nufarm is because of omega-3. Now, the world is short omega-3, and Nufarm have a technology that could eliminate this shortage. The omega-3 story is incredibly simple. Humans are eating a lot more fish these days. For fish to grow, they need to consume omega-3, and currently the only way they can consume that is through smaller fish like anchovies and other crustaceans. The experts believe that omega-3 demand will grow by around 6% per annum over the next decade. And that's very consistent with recent industry trends as well. But here's the opportunity for Nufarm. The experts also agree that the supply of omega-3 won't grow won't increase from the oceans, mainly because a lot of the oceans now have been broadly fished out. And this is the opportunity for Nufarm, this ever-increasing supply gap. Now, Nufarm's been working with the CSIRO for over 15 years to develop a seed that will produce omega-3 in plant-based canola. The research we've done is that within the next 2 to 3 years, Nufarm will be able to get around a 20% market share of this ever-increasing supply gap. And if they can do that, this technology will be worth over $1 billion to the market capitalisation of Nufarm. So it's a great opportunity for industry consolidation and clearly this omega-3 opportunity. Again, Nufarm is just way too cheap. It's trading on today 7 times EV to EBITDA, and that's excluding having zero value for Nufarm. Under all normal circumstances, without omega-3, it is actually worth $8.20 a share. And if we're right with this technology on omega-3, this company is worth over $10 a share, well over 60% upside of where it is today. So thanks again for your time. As you can see, the Aussie equity market has been a great investment for long-term investors. 2018 was volatile, 2019 will continue to be volatile, but all this uncertainty will create a lot of opportunities in all parts of the market, which is why it's important for Firetrail to look at all areas to add value, both growth and value stocks. To us, every company has a price. Our 2 best ideas for 2019 is Wally, the global engineering firm, and Nufarm, the global crop protection firm. So thanks again for your time.